Who can actually afford a $500,000 house in 2026? It's a question that's quietly haunting a lot of people right now. Maybe you've scrolled through listings, done the mortgage calculators, and wondered, is this even realistic for someone like me? Let's look at a real-world example. Meet Sarah, a 29-year-old marketing manager living in Dallas, Texas. She earns $85,000 a year before taxes. After taxes, her take-home pay is about $5,200 a month. She's single, rents a modest apartment for $1,600, drives a car with a $350 monthly payment, and pays $300 a month toward her student loans. Credit card bills and everyday expenses, groceries, utilities, a gym membership, and the occasional night out add another $1,200. Sarah's story isn't unique. In Berlin, Germany, Lucas is a 32-year-old software developer earning €60,000 a year. After taxes, he brings home about €3,000 a month. His rent is €1,200, car payment €250, and he's still paying off a small student loan. His monthly expenses, including food, insurance, and a few social outings, total around €1,000. The hidden financial mistake: system flaw. Both Sarah and Lucas have stable jobs and decent incomes, but when they look at buying a $500,000 house, the numbers don't add up. Why? Because the system quietly encourages us to stretch for the biggest house we can afford on paper, not what's actually sustainable. Banks might approve you for a mortgage that eats up 35% or more of your gross income, but that doesn't account for property taxes, insurance, maintenance, and the reality that life is unpredictable. The hidden mistake is assuming that if the bank says yes, you must be able to handle it. Simple math, the real cost. Let's break it down. A $500,000 house with a 20% down payment means a $400,000 mortgage. At a 6% interest rate over 30 years, that's about $2,400 a month before taxes and insurance. Add another $700 for those, and you're at $3,100 a month. For Sarah, that's nearly 60% of her take-home pay. For Lucas, it's even higher, and that's before you factor in car payments, student loans, or the cost of living. The math shows that for many, a $500,000 house isn't just a stretch, it's a financial risk. Psychology: why we make this mistake. So why do so many people try anyway? Part of it is psychological. There's a powerful urge to move up in life, to own a home that reflects your hard work and success. Social media, family expectations, and even well-meaning friends can make it feel like you're falling behind if you don't buy as much house as you can possibly get. There's also the belief that home ownership is always a smart investment. But in reality, stretching for a bigger house can leave you house poor, owning a home but with little left for savings, travel, or emergencies. Long-term impact if ignored. If this pattern continues, the long-term impact is clear. High mortgage payments mean less money for retirement, investments, or even basic enjoyment of life. One job loss or unexpected expense can turn a dream home into a source of stress and anxiety. Shift perspective. Financially intelligent mindset. Financially intelligent people think differently. They don't let the bank's approval set their budget. They look at their real after-tax income, their actual expenses, and what's left for savings and living. They understand that a home should add stability, not stress. They focus on what truly matters: financial flexibility, peace of mind, and the freedom to make choices, not just the size of their house. Conclusion: calm, logical, soft CTA. So before you fall in love with that $500,000 listing, take a step back. Ask yourself, does this home fit my life, or am I trying to fit my life around this home? If you found this perspective helpful, consider subscribing for more calm, honest conversations about money, mindset, and real-life financial decisions.